Welcome, dear traders. Optimism in the Asian stock markets ebbed away due to a drop in China's shares and the surge in the US government bonds. Yesterday, the yield of a government notes soared above 4% for the first time since early October. It signals a further upward movement of the US dollar and the fall in its stocks. Asian Pacific currencies declined again after a short respite. Wall Street lost momentum, dragging down Asian stock markets. Investors are now uncertain about what strategy to choose. A soft landing looks likely, given the upbeat US economic reports. China's reopening is also positive for Asian markets. However, the risks of a higher inflation and the Fed's tightening cycle are weighing on the sentiment. Traders have to accept the fact that the Fed will be committed to a hawkish stance for a longer period of time. Currently, they assume the key rate may be hiked by 5.5%. A few weeks ago, they reckoned that the interest rate would reach a restrictive level of 5% in March and stay there. By the end of the year, the Fed was expected to ease monetary policy. The majority of investors are betting on a 25 basis point rate increase at the March meeting. However, there are also many traders who do not rule out a more aggressive rate hike by 50 basis points. Now, 53% of speculators believe that the interest rate may exceed the 5.5% range. On February 28, only 41.5% factored in such a scenario. For this reason, traders are now rather cautious. China's stocks were rather volatile. On the Hong Kong Stock Exchange, they traded in the red. In the New Zealand, shares dipped lower. Australian stocks climbed against the backdrop of rising commodity prices. Japanese ones were also up amid increased risk appetite yesterday. Just a few days ago, the US dollar seemed unstoppable. However, yesterday it tumbled to 104 points due to strong bearish pressure. In the morning, the situation changed drastically. Bulls regained the upper hand thanks to hawkish comments of Fed policymakers. The US dollar index rose above 104 on Thursday, offsetting some of its early losses. Atlanta Fed President Rafael Bostic called for continued rate hikes above 5% to ensure that inflation doesn't accelerate again. Minneapolis Fed President Kashkari said that the monetary tightening does not have a big impact on the services sector. Today, weekly jobless claims data and Christopher Water's speech are on tap. The US currency is likely to grow higher in the near future amid a resilient economy and aggressive rate hikes. However, there is a chance that the regulator could undertake a smaller rate increase. Even so, the US dollar is sure to sink. With a further decline, the short-term high is seen at 105.30. A breakout over this level will signal the resumption of a rally. So the February high is now a kind of a pivot level that will determine the trajectory of the greenback. Today, Japanese policymakers discussed some issues regarding monetary policy. There has been some kind of a confrontation between the incumbent and incoming governors of the central bank. At a confirmation hearing at the lower house, Katsuo Ueda said he had ideas on how the central bank could exit its massive stimulus. He stressed that the shift to a hawkish stance would occur only when inflation increases significantly. Haruhiko Kuroda called on politicians to conduct a review of monetary policy given the current level of inflation, as the consumer prices in other countries have recently surged again. It somehow limits inflation in Japan. The dollar-yen pair moved yesterday in a wide range. In the Asian session, it was trading without a clear-cut trend as well. However, the yen is unlikely to climb versus the US dollar. It looked oversold, so a correction was necessary. It took place amid fundamental factors, and the outlook for the pair remains unchanged. To confirm the upward scenario, the pair needs to consolidate above 136.90 points. Otherwise, it will hardly be able to reach 137.90. In the Asian trade, it resumed upward movement, gaining 0.4%. Despite yesterday's rise, the Aussie is still weaker than the US dollar. The AUD-USD pair may hit the bottom later this week. Its trajectory is now determined by the movements of the US dollar. The Aussie maintains its bearish bias amid the US strong macro stats and the Fed's hawkish comments. These two factors undermined risk appetite. Chinese upbeat data overshadowed gloomy domestic reports in Australia. However, sooner or later, traders will not be able to ignore them. Judging by fresh economic reports, aggressive tightening is working, although the Reserve Bank of Australia will have to undertake more rate hikes to cement victory over inflation. Inflation remains stubbornly high in January, adversely affecting household spending. It means that the Reserve Bank of Australia should remain hawkish to cap inflation despite a weak GDP. A breakout below the support level of 0.6780 will facilitate a downtrend. The pair may hit the target level of 0.6660, and the New Zealand dollar came out on the top yesterday amid news from China. Apart from that, it regained ground thanks to expectations of a further rate hikes by the Reserve Bank of New Zealand. Hence, the kiwi became the most attractive commodity currency yesterday. And as the economic calendar in the Asian session is almost empty today, traders keep an eye on the US dollar movements and technical indicators. The Kiwi dollar pair may try to test the resistance level of 0.6305 despite the feeble upside potential. However, this scenario looks unlikely. In the morning, New Zealand dropped sharply, losing yesterday's gains. It could decline to 0.5925. However, the pair may resume an upward movement if it advances above 0.6385. And that's all for now. Hit the subscribe button and stay up to date with the latest market news. See you soon.